taxes, investing, and estate and retirement planning? Well, I went to school so you don't have to. Welcome to Finances and Tax Updates for 2021. Finances and, in conjunction with my company, Capital Coaching, helps people achieve their financial goals through personal, tailored, and attentive financial coaching services. Together, we create a successful financial plan by examining your spending and saving habits, and then guiding and educating you to personal success. Coaching services include evaluation of your spending plan, building your savings, financing your retirement, examining your insurance needs, and planning for your individual goals. Please contact me at capitalcoaching.net to make an appointment for a free consultation. Let me start with wishing you a Happy New Year. I will also say it's not too early to start thinking about your income taxes this year, because although you probably won't start to receive the documents you need until the end of January, it's not too late to make payments and then be able to earn deductions on your retirement accounts. Today, I'll be sharing some of the biggest changes in the 2021 filings. We've probably heard a lot about child tax credits in 2021. They were affected by the American Rescue Plan, also known as the COVID stimulus plan last year. This credit rose to $3,600 per child under 5 and $3,000 per child over 5 and up to 17 years old. This credit is fully refundable this 2021 tax year. Many people received a percentage of this credit as cash from July to December of 2021. However, if your modified adjusted gross income is greater than $150,000 for married filing jointly or $75,000 for single, you'll only get a $2,000 credit. So you may file as married filing jointly and say earn $150,000, but when you make retirement contributions of $2,000, your AGI is lowered by that same amount. So the adjusted gross income is less than the $150,000, and you would qualify for that full child tax credit. Capital gains are also affected, and that's when an asset that you own is sold and it's gained in value. These can include stocks or bonds, real estate, even property like RVs or boats, almost any asset that you sell for more than what you paid for its purchase for your own personal use. And as an individual, you're taxed at 15% on long-term capital gains, meaning that you've owned it for more than 1 year and 1 day. As long as your income falls below $501,660 for married filing jointly or $445,850 for singles. Those who make more than those two amounts will pay 20% on their capital gains. To encourage investing, anyone making less than $80,800 and married filing jointly, or less than $440,400 as a single, will pay no tax on their gains and will be able to keep their profits as their investment grows. But anyone selling their investments prior to 1 year, you'll be paying the same amount as you do in taxes on your income, called your ordinary rate. So holding on to it is advantageous for tax purposes because you'll keep more of the money you've earned as your investments grow. Another change is if you've adopted a child with special needs in 2021, the credit that you can receive goes up to $14,400 per family with a modified adjusted gross income of less than $216,660. You can claim the full amount. Anywhere between the $216,660 can claim the full amount. If your income is between that and $256,660, you'll get a partial amount, and anyone above the $256,660 will not get any of that credit. The credit means that you do not get money actually back from the IRS, but rather it retires or reduces a tax that you owe. If you owe $10,000 and qualify for the $14,400, you would pay no taxes that year. Retirement plans also have changes like your 401k, 403b, 457 plans, and thrift saving plans. The limits that they've set for 2021 are at $19,500, and the catch-up amounts are $6,500 for those that are 50 or older. Those are the amounts that you can contribute to those plans. IRA contributions are maxed out at $6,000, and those 50 plus can catch up, and catching up means you can put in a bit more than people who are younger, so you can catch up on your savings with an additional $1,000. But don't skip contributing to these great retirement vehicles. Your retirement is more important than a deduction. The The standard deductions have gone up this year as well. That means that you can deduct, no questions asked, the following from your income. For singles, that's $12,550, and married filing jointly is $25,100, which in turn reduces the taxes that you pay on your income. Standard deductions are great if your itemized deductions are not larger. Generally, but not always, if you own a home, itemizing is the way to go. You can check the amount of mortgage interest that you've paid on your Form 1098 INT from your mortgage company, and if it's more, then you itemize. If it's much less and you don't have to pay property taxes, state income tax, or donations, then you'll take the standard deduction. If you're using a tax software, they will actually check it both ways for you to see which is most advantageous for your circumstances. So it's another great reason to use those online programs. However, those who do owe more in mortgage interest than the standard deductions, you're going to be itemizing and you'll be able to deduct other items if you've kept receipts for them. That includes medical expenses, property taxes, charitable contributions, student loan interest, state and local taxes that you've paid, gambling losses that you've made, any contributions to your IRA, your 401k, or your 403b, and then expenses that you might have as self-employed, your home office, or educator expenses as well. Deductions reduce the amount of taxable income that you have. Deductions reduce the amount of taxable income you have, which reduces your taxes. These are different than tax credits, which reduce your tax bill, allowing for a refund of that money. If you owe $1,000 and have $1,200 in credits, you'll get a $200 refund. Deductions sound good, and they really are, but credits reduce what you owe. So that example of a $10,000 deduction on an AGI of $100,000 could mean that you owe $22,500 in taxes, where a credit of that $10,000 on the same $100,000 income can mean that you owe only $15,000 in taxes. And although it's a large amount, it's a huge difference of $7,500 in taxes. So look for those credits and be sure to save your receipts so that you can claim them. The lifetime learning credit, which allows you to deduct up to $10,000 for an unlimited amount of years at $2,000 per year, phases out, which means that you can no longer take it, with the MAGI of $59,000 to $69,000 for singles and between $119,000 and $139,000 for joint returns in the 2021 filing year. So if your income is less, you can claim the full $2,000 each year until you reach a maximum of $10,000. But between those ranges, it starts to get smaller until you reach the upper limit when it disappears for you. This credit can be used against any taxes you owe, and it will not come off as a refund to you. Earned income tax credits are credits that you get back from the IRS if you're a low-earning wage taxpayer. This was created so that low-income workers can help offset some of the Social Security taxes that they pay each paycheck. Tax bracket thresholds have also changed this year. These numbers are based on your AGI, so when you take all the deductions and credits that you're allowed, it will reduce the amount of taxes you've owed. In 2021, the brackets are for married filing jointly, and then the second will be for singles. 10% will be for less than $9,900 or $9,950. You'll pay 12% over the $19,900 or $9,950. 22% for people who make over $81,050 or $40,525. 24% for $172,750 or $86,375, 32% for over $329,850 or $164,925, 35% for over $418,850 or $209,425, or you max out at 37% if your income is over $628,300 for married filing jointly or $523,600 for singles. You're taxed on your marginal tax rate, and that's the bracket that your adjusted taxable income falls into. As your pay goes up, you move into the next tax bracket. It's not quite as simple as if you make a dollar amount and you owe a certain percent on your salary. Instead, for each bracket, you owe a percent when your salary is in that bracket. Let's say that in 2021, a single filer earns $86,376. You're going to pay 10% on that first $9,950. You'll pay 12% on the amount between that and $40,525. You'll pay 22% between that dollar amount and the $86,375, and then you'd pay 24% on that one last dollar. Even though your AGI would place you in the 24th percentile, the actual cumulative tax liability, also called your effective tax rate, is only about 20%. You do not pay 24% on your salary in total. Each time your salary puts you into another bracket, only the portion in that bracket is taxed at that rate. Investopedia explains it as, in a progressive tax system like the one in the U.S., income is taxed at differing rates that rise as your income hits certain thresholds. I just realized that progressive in this case means that as your income progresses, your taxes do as well, not that the system itself is somehow progressive. Well, that's a brief overview of the tax changes for 2021. Thanks for listening to Finances and Tax Updates for 2021. I know you chose to listen and I'm grateful. If you enjoyed this episode, please follow or subscribe for free in your podcast provider and share your favorite episode with a friend. Consider leaving a review because it brings financial education to others and helps people find me more easily. Please let me know what questions you'd like answered or what topics you'd like covered by going to the website at financesand.net and leaving a message. You can also contact Capital Coaching for your personal financial needs at capitalcoaching.net. Finances and does not provide tax or legal advice, and nothing in this podcast is to be construed as such. Always consult a tax, accounting, or legal professional for advice on your specific situation. Remember, I went to school, so you don't have to.